Welcome back to Investing Talk podcast. Today, we are focusing all our attention on one of the foundational pieces of the modern digital economy, Equinix. And the big question we're tackling, based entirely on this stack of recent SEC filings, analyst reports, and technical data we've gathered, is pretty straightforward. Is Equinix, the big data center REIT, a good buy right now? Before we really get into the weeds here, just a quick reminder, please hit that subscribe button, give us a like if you find this useful, and definitely leave a comment below. Oh, and yeah, if there's a specific company you want us to examine in a future show, drop the name in the comments. We actually really enjoy digging into the companies you're interested in.
That's right. Our goal here is really to cut through all the noise. We're using the very latest data we could find right up to September 20th, 2025 to figure out where Equinix stands. And crucially, does the risk versus reward setup make sense for your portfolio at this moment?
Okay, let's unpack the business itself. Start with the core idea. Why do the sources seem to view Equinix as almost, well, indispensable? We know it's the largest global interconnection data center REIT. 260 plus data centers, 5 continents. It's massive, but that scale alone doesn't guarantee a competitive moat, does it?
No, it doesn't. You're right. The real advantage, the moat, isn't just the physical space, the square footage. It's the ecosystem they've built. Their core strength isn't just hosting servers. It's being that central global hub. It's where these huge networks, big enterprise clients, and the cloud providers, the hyperscalers, all meet and interconnect. That's the whole platform Equinix idea.
Right. And that's where the network effects really tick in, isn't it? That's what the sources highlight. Because they have such diverse customers geographically and by industry, every time someone new joins, say, a major AI company, it makes the whole platform more valuable for everyone already there.
Exactly. It creates these incredibly high switching costs. Think about it. If you're a financial services firm and you're connected to, say, 50 different partners inside Equinix's system, moving all of that to a different provider, it's exponentially more complex and expensive.
So that stickiness, that's what translates into their premium valuation and I guess their strong financial performance too.
Precisely. That stickiness underpins a lot of it.
Okay, let's look at the numbers then. 2024 seemed solid based on the reports. About $8.23 billion in full-year revenue. That's up roughly 13% year over year.
Yep, and pretty efficient too. Adjusted EBITDA hit $3.82 billion, giving them a really strong 46% margin.
Okay, solid. But we have to talk about that Q2 2025 result. The sources made a big deal out of it.
Oh, absolutely. That Q2 earnings beat was, frankly, enormous. The reported EPS came in at $9.91. Compare that to the analyst consensus estimate, which was just $3.49. That's a huge, huge gap.
Wait, hang on. 991 versus 349. That's an unbelievable miss by the analysts. Are the sources saying the market just completely whiffed on the AI boom's impact, or was there some kind of one-off event inflating those numbers?
Well, the primary reason cited in the material is really that surge, almost parabolic demand for AI and the related network infrastructure, specifically those high-margin interconnection services. While there are always, small accounting adjustments here and there, the core driver was definitely operational performance just blowing past expectations. It seems the market suddenly realized just how fast this AI infrastructure shift was happening. They were underestimating the velocity.
Okay, that makes sense. And that renewed optimism seems baked into their forward guidance now, too. Management's projecting, what, $8.5 to $8.6 billion in revenue for the full year 2025, and adjusted EBITDA between $4.0 and $4.1 billion.
Correct. And analysts, for the most part, seem to be expecting margins to hold steady, with revenue growth continuing at maybe 6 to 8% annually over the next couple of years. So yeah, fundamentally, it looks like a pretty sound foundation.
It does, but let's check the scaffolding, as you say. They need to keep building to stay ahead. The balance sheet shows total debt of $15.8 billion, net debt about $14.3 billion.
That is a big number. But putting it in context, the net debt to adjusted EBITDA ratio, it comes in around 3.7 times. And the sources are pretty quick to point out that this is fairly typical for the data center REIT sector.
Yeah.
So it suggests the leverage is manageable,
But it highlights the cost of maintaining that leadership, right? They need that capital.
that's the key implication, yeah. They rely heavily on debt to fuel that constant, crucial capital expenditure. Look at 2024. They generated $2.96 billion in operating cash flow. Strong number. But then you subtract the $2.36 billion in CapEx. I mean, they're always building huge projects globally. And that leaves only about $600 million in free cash flow. So it's clear they're prioritizing growth, market share, market dominance over just generating immediate free cash flow yield.
Yeah, it really feels like a growth stock that just happens to be structured as a REIT. And speaking of the REIT structure, the dividend payout is $16.68 per share annualized. That yields around 2.1% at the recent price. Definitely not an income play primarily.
Not at all. It's about total return, mostly capital appreciation potential.
Okay, so we've established the fundamentals seem pretty strong. You've got secular growth, a sticky business model. Let's shift gears now to the technical picture because the question is, okay, fundamentally strong, but how does the stock price look right now? Is it extended?
That's the right question. Fundamentals tell you what to buy. Technicals often help with when. So as of Friday, September 19th, 2025, the stock closed at $791.25. And yeah, it's been trading right near the top end of its recent range.
And the sources defined that recent range pretty clearly, didn't they? Between roughly $740 on the low end and $790 on the high end. That helps frame the immediate picture.
Exactly. So the key immediate support zone, according to the technical analysis we looked at, is down between $740 and $760. If the stock pulls back, that's likely where buyers who believe in the story might step in. Conversely, the main resistance area, where selling pressure has shown up, is between $800 and $820. A solid, sustained break above $820 would likely signal a significant new upward move.
And connecting that to the bigger picture trend, the moving averages seem supportive.
They do. Both the 50-day moving average, which is around $765, and the longer-term 200-day moving average, near $7,305, are both trending upwards. That confirms the overall constructive bullish trend is intact.
What about momentum? Is it running too hot?
Good question. You check the speed limit, right? Momentum indicators suggest, well, it's warm, but maybe not boiling over to wildly speculative territory just yet. The Relative Strength Index, the RSI, is sitting at 62. Now, technically, anything over 70 is overbought, so 62 suggests it's, let's say, mildly overbought after the recent run, but momentum is still positive. It's not screaming sell.
Okay, and the MEXCD, I saw that mentioned too.
Yeah, the NANCD also confirms positive momentum. It actually showed a clear bullish crossover signal back in early September 2025.
What's interesting, though, and the sources noted this, is the elevated volatility recently compared to its history.
Right, and that increase in the trading range and the sort of speed of movement seems directly tied to that broader market theme, everyone piling into AI infrastructure plays. There's just a lot more attention, more money flowing into this space right now.
You can see that attention in the trading volume too, can't you? That huge spike on September 19th.
Absolutely. Volume was up 140% over the average. That points directly to significant institutional activity. Big funds rebalancing, maybe accumulating more shares, adjusting positions after digesting that huge Q2 earnings report.
And ownership reports seem to back that up. Continued buying by big players.
Yeah, the filings show continued accumulation by large firms, like IFM Investors was mentioned. It signals that, despite the higher price tag now, institutional confidence in the long-term story remains pretty strong.
And the analysts are largely singing from the same hymn sheet, right? Consensus seems very positive.
Overwhelmingly so. The consensus rating is basically buy or overweight. Most price targets are clustered between $850 and $900. So, yeah, it's almost universally bullish sentiment among the analysts covering it.
Almost universal.
Well, I should mention there was one outlier. Noted Wall Street Zen issued a sell rating that usually reflects maybe a proprietary valuation model flagging it as expensive, but it's definitely a small divergence against a very strong positive consensus.
And it seems the company is backing up that optimism with execution. They're actively building, right? 59 major projects underway.
Yes, across 34 different metro areas globally. They're clearly focused on ensuring they have the capacity to meet that booming demand. Plus, they just closed that acquisition of 3 data centers in Manila, further deepening that global footprint we talked about earlier, which is so key to their competitive advantage.
Okay, so if you're holding the stock or considering it, what are the key catalysts to watch for next?
Well, the big one, the hard catalyst everyone's focused on, is the Q3 2025 earnings release. That's likely coming up in late October, probably around October 30th. The big question is, can they beat expectations again?
Right. And beyond earnings, any other market events?
There's always potential volatility around major ETF rebalancing periods, often in November, and the institutional ownership filing deadline is in December. Those can sometimes cause short-term price swings as big funds adjust their holdings.
But the underlying multi-year driver, that just seems to be the ongoing acceleration of AI and cloud demand, right? That's the core narrative.
Absolutely. This isn't just a quarterly story. It's viewed as a structural shift, and Equinix is seen as perfectly positioned to benefit from that for well, potentially the next decade or more.
Okay, now, we have to bring in a dose of reality checks, risks. Let's talk insider activity first. The sources did mention some recent insider selling.
Yes, they did. Filings showed directors and executives selling shares in August and September 2025. But it's really crucial to understand the context here. The sources clarify these sales were mostly, if not entirely, related to restricted stock units vesting under pre-established 10b5-1 trading plans.
Ah, the 10b5-1 plans. So explain that quickly. This isn't necessarily them thinking the stock is peaking right now.
Exactly. A 10b5-1 plan means the executives set up a schedule for selling shares months in advance at a time when they presumably didn't have any material non-public information. It's a way to systematically liquidate vested stock over time for diversification or financial planning. So it significantly mitigates the negative signal that spontaneous insider selling might usually carry. It's planned, not reactionary.
Got it. That's important context. However, it was also noted there hasn't been any recent insider buying reported in Q3 either.
Correct. No significant open market purchases by insiders recently.
Okay, so moving beyond insiders, what are the main risk factors that could potentially derail this positive story?
Well, first, company-specific risks. Execution risk is a big one. Building and managing these massive, complex data centers globally. Delays or cost overruns on that huge $2.36 billion annual CapEx budget can really hurt earnings.
And tenant concentration. Even with diversity, they rely heavily on the biggest cloud players, right?
They do. While they serve thousands of customers, a significant chunk of revenue comes from the largest hyperscalers and cloud providers. If one of those giants were to dramatically change its infrastructure strategy or spending, Equinix would definitely feel it.
And then there are the sector-wide risks. As a REIT, it's sensitive to interest rates naturally.
Highly sensitive. Higher interest rates make their debt more expensive, which is critical given the reliance on it for CapEx. Plus, higher rates generally put pressure on high multiple stocks like Equinix, making their valuation less attractive compared to safer assets like bonds.
And competition isn't going away.
Definitely not. There's competition from other data center REITs, of course, but also ongoing competition from non-REIT private players and even from the hyperscalers themselves, Amazon, Google, Microsoft, who are always building out their own internal capacity, even while they still rely on Equinix for that crucial interconnection piece.
Okay, so bringing it all together, after sifting through all this data, the financials, the technicals, the sentiment, the risks, what's the overall synthesis? How does it stack up?
Synthesizing everything, the sources seem to land on a pretty strong overall rating, maybe an 8 out of 10. You've got these powerful secular tailwinds from AI and digital transformation. You have clear global leadership and a sticky business model generating stable high margins.
But there's always a but. The main hesitation seems to be valuation, right?
That's the primary sticking point, yes. The stock has had a great run. The valuation, looking at metrics like EV to EBITDA, is firmly in the high teens. That's definitely elevated compared to its own historical ranges and often higher than the average for the broader REIT sector. And the technicals, as we discussed, suggest it's a bit extended in the short term.
So the recommendation really depends on your investment horizon.
Absolutely. Based on the analysis, this stock seems much better suited for a long-term investor. Someone focused on that multi-year growth story driven by AI and cloud, who values the company's defensive characteristics and leadership position and is willing to potentially pay a premium for that quality and growth.
Okay. And for maybe more short-term oriented traders?
For them, the technical picture suggests patience might be rewarded. Pullbacks towards that support zone we identified, maybe the $750 to $760 area, could offer potentially better entry points with a more attractive risk-reward setup, especially if the broader market pulls back a bit.
All right, so to wrap things up, let's leave our listeners with a provocative thought, something to chew on.
Okay. Given that huge Q2 earnings surprise, the raised guidance, and all the buzz around AI infrastructure, here's something to consider. What happens if that rumored catalyst, a potential major strategic partnership related specifically to AI infrastructure, something that could further solidify Equinix's dominance in interconnection, actually gets announced before the next earnings report in late October?
So would pure excitement about that strategic win be enough to just blast the stock through that $820 resistance level? Or will the current high valuation act as a bit of a damper, meaning even good news doesn't cause a massive spike, and investors really need to focus purely on that long-term conviction regardless of the short-term news flow?
Exactly. It's that constant tension between near-term catalysts, current valuation, and long-term market leadership. That's the balance you, as an investor, need to weigh.